If I told you that behind Australia's housing price surge hides 6 signals of a market turning point, would you believe it? Yes, the RBA cut rates in August to 3.6%, but the minutes reveal deep divisions inside the committee over how much room is left to cut. Today, I'm not repeating the media's daily chatter about rate cuts and price rises. I'm revealing 6 ignition points almost no one talks about, 3 of which could flip the market straight into reverse. What's the real story behind the rate cuts? Why are big institutions so far apart in their housing forecasts? Most importantly, how long can this housing market rally actually run? While the crowd is scrambling to buy, smart money is already mapping exit plans. Remember this, the most dangerous moment is often when everything looks safest. If you don't want to be among the 20% who buy at the top, watch this to the end. Hi, I'm Alex. I hold master's degrees in accounting and business administration. When I worked as an accountant and then a GM of a listed real estate company, I began my property investment journey. Then I started my own company, helping hundreds of people invest in the property market to achieve financial freedom and retire early. And you're watching AusPropertyStrategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. In August, the RBA cut the cash rate to 3.6%, the third cut this year. On the surface, it's great for housing. Everyone's celebrating cheaper borrowing, lighter repayments, easier holding costs, more money to spend, bigger borrowing capacity, and the hope of more cuts ahead. Sounds great, right? But dig a little deeper, and it isn't that simple. The RBA minutes show sharp divisions inside the committee about how much room is left to cut. The big 4 banks are just as split. CBS says there's one more cut by year end, while Westpac thinks November is the last. What does that mean? The easing cycle may be much shorter than people expect. If markets are still partying and the rate cuts suddenly stop or even turn, what happens to investors who maxed out their leverage? Roy Morgan's latest data show 28.4% of mortgage holders are under repayment stress, the highest since January. And note, this came after 2 cuts. What does that tell us? Even with easing, the rising cost of living is still hitting ordinary households hard. It reminds me of the psychology in every past housing surge. Each upswing brings a bidding frenzy. That's classic FOMO. If you see property as a cycle, the bottom is when the curve is at its lowest. Most buyers think prices will keep falling, so they sit out. Sellers, under pressure, try slashing prices to quit, then realize nothing moves and pull listings or stop cutting prices. That's the sign of a bottom. Only about 1%, the seasoned investors, buy at the bottom. At the bottom of the last 2 cycles, we at AusPropertyStrategy told all Vision members to act. Those who bought are really happy now. Of course, they had spare cash and capacity to borrow, which we planned for them at the beginning of the membership. After a while, the market stops falling and starts to lift. About 10% of faster-moving investors step in. Then we hit the clearest part of the upswing. Right now, when roughly 70% of investors get in, rush in and try to catch the wave. That's when prices rise fastest. Finally, at the peak, the most cautious 20% see friends and relatives making gains, jump in at last, only to buy the top. So what exactly is driving today's red-hot market? People think soaring prices come from too many buyers, too little stock, and easy policy. The truth is far more complicated. CoreLogic's latest report shows that while prices kept rising in July and August, new listings actually climbed 8% over the same period, meaning supply isn't as tight as most assume. ABS data for Q1 shows only 42% of new mortgages were for owner-occupiers. Nearly all the rest were investors. In other words, this surge is being propped up by investment lending, not genuine home buy demand. What's more surprising, a mortgage choice survey found over 60% of investors bid 15 to 20% above the local median price, focused on winning the auction, not on the future rates. In inner Melbourne, one bidder said, "I'm here to secure the spot. Rates can wait." That get on the ladder first mindset is FOMO in its purest form. This FOMO is harmful, but it won't automatically trigger a crash. Even if rates rise another 0.5 percentage points in the next 12 months, only 22% of investors would face cash flow shortfalls where rent no longer covers interest. High, yes, but not a systematic brick. Domain reports that despite faster turnover, average days on market fell from 35 to 28. The quicker pace reflects continued hopes for a low-rate window rather than blind, no-question-asked buying. In some areas, price gains have spread from city centers to surrounding satellite cities, suggesting buying to switch suburbs is supporting the market, not just a speculative bubble. So how long can this run last? Major banks and research houses differ in optimism, but most see the upswing continuing for the next 12 to 18 months, with speed and regional outcomes diverging. CBA expects national prices up 6% by end of 2025, Sydney 6.3%, Melbourne 5.8%, Brisbane up to 7%. Westpac is more cautious, 5% for the year, with Sydney 4.5%, Melbourne 5.2%, Brisbane and Perth 6% and 6.5%. ANZ sees national gains of 4 to 6%, Sydney 5.8%, Melbourne 5.3%, Brisbane 6.1%, and a clear slowdown starting Q1 2026. KPMG projects only 2% growth in Q1 2026, noting Sydney's inner city and coastal Victoria as likely outperformers. Most institutions agree on 4 points. Number 1, national gains will be between 4 and 7%. Number 2, Sydney and Melbourne are the main pace setters. Number 3, Brisbane and Perth may rise faster on affordability and migration. Number 4, growth likely peaks around Q1 to Q2 2026, then eases. This time I agree with the big 4. Over the next 12 to 18 months, the trend is to remain stable. So when might the turning point arrive and prices swing down? If you have any questions about property investment, please book a free 15-minute discovery call on our website. If you want a team offering one-stop service to help you build a property investment portfolio, achieve financial freedom, and retire early, join our Vision membership by booking a 30-minute obligation-free discovery session to start with. Or to keep it simple, our data-driven buyer's agency service can help. We buy and manage properties for our clients anywhere in Australia. Links to the service are in the description below. Australia's housing market swings in the short term but climbs in the long run. Here we're talking about the short-term swings. Under what conditions could this upswing hit a turning point? Number 1, major shifts in immigration policy. Immigration is the engine of Australia's housing boom. More people, more workers, more wealth, direct demand. If that engine weakens or stalls, the investment logic fundamentally changes. Historical data show that for every 1% drop in immigration growth, prices decline by about 0.8% in the following quarter. Cities reliant on migrants like Sydney and Melbourne would feel it most. Yes, during the border closures, government subsidies, fiscal stimulus, and rate cuts can push prices up for a while, but when those boosts fade, the turning point arrives. In the short term, there's no sign of Australia actively cutting migrant numbers. On the contrary, student visa quotas were just lifted. A new wave of migration may be starting. Number 2, rates turning higher. A new hiking cycle would also flip the market. Right now, most expect the RBA to pause cuts in September. If inflation pushes back towards 3%, the RBA will have to lift again. Every 25 basis point rise adds about $120 to the average monthly repayment and tightens investor borrowing power. Rising rates force a broad repricing and revaluation. The RBA's decision depends on inflation and jobs, and the latest data show a hint of inflation reacceleration, though the broader trend still needs monitoring. Number 3, removing investor tax breaks. Negative gearing and the CGT discount are regularly floated for change by the media and think tanks. A recent proposal limits these perks to the first investment property. If adopted, over 600,000 investors could lose about 30% in annual tax benefits, pushing some high-leverage buys to exit early. At the same time, the Prime Minister has said these concessions won't be changed, but no one knows how long that stance lasts. Number 4, high taxes on investors. Beyond removing perks, unions and some states are pushing vacancy taxes and higher stamp duty on investment properties. Victoria's Treasury has proposed lifting vacancy taxes and adding progressive stamp duty for multi-property owners. If enacted, these measures would further squeeze cash flow and make high-leverage positions hard to sustain. Number 5, APRA tightening credit. APRA has said it will keep the 3% serviceability buffer and won't let banks loosen standards. A financial stability review noted that cutting the buffer to 2.5% could inflate borrowing capacity by $276 billion, an unacceptable high risk. But if the buffer rises to 3.5%, credit would contract sharply and housing would adjust in turn. Number 6, the 2028 election. In election years, investors commonly wait because it's hard to tell what policies will be implemented. Investor decisions slow and monthly investor loan applications drop. The affordability issue will likely dominate the next election. If the winning party swings hard on immigration or taxation, housing reacts immediately. Among these 6, the most important signals are immigration, taxation, and APRA credit policy, because once they shift, they can trigger a near-term turning point. Based on what we see now, the change of such shifts in the next 12 to 18 months looks low. And that's one reason I expected the market to keep rising over that period. The only unknowns are the month-to-month pace and the total magnitude of gains. No one knows it. So how should investors respond? Buy or wait? For owner-occupiers, any time can be the right time to buy because one typically holds the property for 10 years or more. Pre-pandemic cycles were roughly 5 years. Post-pandemic cycles have shortened to 2 to 3 years. You'll likely ride 3 cycles in a decade, smoothing out the cost of missing the absolute bottom. If your finances are ready, buy. For investors, it's still a solid entry window. In Australian residential property, time in the market beats timing the market. If you can time it, returns improve, but most people can't. Even I can't nail the exact bottom either. At best, I buy near it. Over the past 5 years, those who bought with us at AusPropertyStrategy, including Vision members who bought consistently, have done very well. If the market does peak around the second half of 2026, what should seasoned investors prepare for? First, total your property's annual net negative cash flow at today's rates. That's the cash buffer you should reserve for housing. If beyond that you still have spare cash and borrowing capacity, consider adding some high cash flow assets to prepare for the next 18 months. But if you're just starting your portfolio, always prioritize capital growth. For many investors, this is the last window before the train leaves. If you haven't bought it, move quickly. The next one may not arrive for 1 to 2 years. For all our AusPropertyStrategy channel fans, I'm excited to launch our very first webinar in the APS Market Insights series. It's happening this Thursday, September the 4th at 8 p.m. Sydney time. In this live session, we'll break down everything that's been happening in the Australian housing market throughout August, including key trends, local economic fundamentals, and what's happening globally that could affect property prices in Australia. And we'll wrap up with the live Q&A. Seats are limited, so make sure to register now on our website, or just click the link in the description below. If you made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos. Have a good one. Bye.